So in the last video, we did the next few transactions for our company that we're working on, Looper Company. Now I noticed that, and you probably have as well, that we're doing journal entries, but we're not posting them. And, the focus of our lesson here is to be able to do the journal entries, calculate the discounts, calculate cost of goods sold, and so on. But just keep in mind that we would have to post these to the T accounts, and we would have to carry them through the trial balance and so on. So just keep that in mind. So our next transaction is on the 15th, and we sold merchandise inventory to Java Company, 3,200, 210, net 30 of the terms of the cost of goods of 1320. So what we could do is we could just copy this, paste it down here, and we're going to change this to Java. And so our sale amount was 3,200. And again, we might want to highlight this. Okay, so when we do our calculation up here, it'll be a little bit easier to find everything. And our cost of goods is 1320. And we said we were doing that in blue. Okay. So remember, under the perpetual method, we always have to do the cost of goods sold entry whenever we have a sale. Okay? Whereas if we were doing the periodic method, we wouldn't be doing that. Okay, so on the 22nd, it said we paid Terran wholesalers in full. So with Terran now, we had $4,000 purchase on the 9th, and we received an allowance on the 13th. Then we have to make sure they are within the discount period. And so that was 10 days. So they are not within the discount period. So there is not going to be a discount for them. So what we have to do then is we have to pay $3,800, right? So we didn't have the discount here because we didn't make the discount date. So basically, to summarize, we have to pay the $4,000 minus the $200 allowance they gave us. Okay, so in this case, there's not going to be any discount. So we're just going to debit accounts payable for Terran for $3,800 and credit cash. Okay, so if we miss the discount date, we can't take advantage of the discount. Remember, the purpose of the discount from both purchases and sales perspectives is to get people to pay early, right? It's an incentive to pay early. Otherwise, no one would pay early, obviously. Okay, so now on the 23rd, it's like Java returned $900 of the merchandise to us. So Java was a company that we sold merchandise to of $3,200. They're now returning, okay, $900 of it. Okay. So what we need to do is first we need to take in the inventory that they're returning. Now we may end up returning it to the wholesaler. We don't know why they're returning it. It doesn't tell us. But if it's defective, okay, then we need to, figure out what to do with it later. But for now, we're taking it back into our inventory, and we're going to credit accounts receivable. Okay, we're going to credit accounts receivable for Java because, if we're allowing them to return merchandise, they don't owe us the money anymore. Okay, and then what we also have to do, okay, is put it back into cost of goods sold, right? Because that's where it came out. So really this is an inventory. This is a sales return, okay? The inventory would actually go here, right? So we would have inventory. And it wouldn't be the $900. That's the retail price, right? It would be the cost. And then we would credit cost of goods sold because that's where it came out. Now, a publicly held company would have to do this a little bit differently because, again, they're using that different method. But for us here, we're gonna go with what the book does. So this is actually sales returns and allowances, not inventory. Okay. So that's going to be a reduction in our sales. And when I said, back in the first video that this wasn't going to be a perfect number, it's because we're not including the sales returns and the discounts and so on. When we do the income statement, we would have to include all that. This is just to kind of give us an idea up here. Okay. Okay, and then on the 26th, we sold merchandise inventory for cash. So that's easy. We don't have to worry about a discount. It's just a debit to cash for $1,900. Credit to sales revenue for $1,900. And of course, we have to do our debit to cost of goods sold and our credit to inventory. And that's $700. Okay? And of course, there's no terms or anything because it's cash. Just like this last entry on the 30th, we purchased merchandise inventory for cash. There's no terms, no discounts, anything like that, because we're just making the payment right up front. And it's FOB destination, so we don't have to worry about any freight costs. Okay. Now, as far as the sales revenue and the cost of goods sold, remember we were highlighting that, okay, to help us do our calculation. Okay. So, let's do our sales first. Now remember, this is not an official calculation. That's something we would do on the income statement where we would actually have to worry about what's called net sales, which is sales minus sales discounts minus sales returns and allowances. For right now, we just want to get an idea, okay? So we're going to pick up all of our sales revenue. So I think there's only 3 of them. And we're going to do our cost of goods sold. Okay. And so our gross profit, let's try that again. Okay, so our gross profit, which is sales, right, minus cost of goods sold, is $62.15. So that's before any other expenses like advertising, depreciation, anything like that. So in order for us to get a gross profit percentage, which tells us of every dollar in sales, what do we get to keep before expenses, we're going to take our gross profit, we're going to divide that by the sales. And it's going to give us 59%. So we get to keep 59 cents out of every dollar to put toward our expenses. Again, not a perfect calculation, but it gives us an idea. Right? So again, I thank you for your attention.